If you're a contractor with rental properties making $300K, $500K, even $1 million a year, and writing massive checks to the IRS each year, you need to listen up. This episode's for you. There's a way to legally use rental real estate losses to offset your contracting income. Yes, even your W-2, even your S-corp income, but you need to get this right. In today's episode, we're going to cover the real estate professional status and see if you qualify, and all the steps you need to take in order to qualify in future years. So let's get started. So if you're new to the channel, welcome. We talk all things accounting for contractors here. My name is George. So a lot of contractors start investing in rental real estate. You buy a duplex, maybe a few short-term rentals, maybe a couple flips you decide to hold. Then tax season comes and your CPA tells you, great news, you had $60,000 in rental losses. You think, perfect, I made $400,000 from my construction business. I'll offset that against my construction income. But then your CPA goes on to tell you that you can't actually do that because of something called passive activity loss rules. Under the tax code, rental activity is considered passive income by default, and passive losses can only offset passive income. So usually you won't be able to offset any passive losses against, say, your W-2, your S-corp, or your business income. And once your adjusted gross income gets above $150,000, the small $25,000 exception disappears as well. So most successful contractors are completely phased out, which means those rental losses, they get suspended. They sit there, they carry forward, and they do nothing for your current year tax bill unless you or your spouse qualify as a real estate professional. Now here's where people get confused. You do not actually need a real estate license or to be a realtor, to sell homes, to work under a broker. Real estate professional is not a career label. It's a tax classification defined by the IRS. And it comes down to time, and there are three main requirements. Requirement number one is 750 hours. You must spend at least 750 hours per year in real estate activities. That's about 15 hours per week, but here's something that's important. It's calculated annually, so from January 1 to December 31 each year. You could do nothing January through March and then go harder April through December and still qualify, so it's total annual time. Requirement number two is more time than your other work. So this is a big one for contractors. You must spend more time in real estate than in any other trade or business. So if you spend 2,000 hours in your construction company and 750 hours in real estate activities, unfortunately you wouldn't qualify. Real estate must exceed your other working time. And this is where many contractors would fail. And here we get to requirement number three, one person must qualify. So if you're married, you can't combine hours. One spouse must individually meet the 750 hours and more time than their other job. But here's where the tax strategy comes in. If your spouse is either not working, works part-time, or transitions into managing your rentals, then they could qualify. And if one spouse qualifies, the entire married return benefits. And that means rental losses can offset contractor income. So I get this question a lot. What counts as real estate time? And of course, a lot of my clients ask, does construction count? And that's a good question. So qualifying real estate activities include property management, overseeing renovations, managing contractors, leasing, collecting rents, bookkeeping for the rentals, rehab oversight, flipping, brokerage work, and property development. So if you're actively involved in rehabs, then that would count. If you're managing subs for your rental projects, that would count as well. And even flipping would count, even if these activities are not directly tied to your own rentals. Another thing, if your spouse gets a real estate license and becomes an agent and helps clients buy and sell homes, then that time would count, even if they manage properties for other investors. So the important thing here is all this, it does not need to be limited to your own rental property. But here's the key, you must materially participate in your rental activities. So you can't just own the properties and let the property managers run everything. So you need real involvement and you need documentation. And if you don't track hours, the strategy falls apart in an audit. So you do need an hours log. So let's take a real world example. Let's say you're a contractor making $500,000. Bonus depreciation and rehab expenses, you generate $120,000 of paper losses. So without real estate professional status, those losses will be suspended. You still pay tax on the full $500,000. With real estate professional status, that $120,000 paper losses can offset your $500,000 of income. And a 40% combined tax rate, marginal tax rate between Fed and state, that's $48,000 of tax savings right there. And that's in 1 year. So now imagine scaling that. And this is why high earning contractors typically pair their construction income with strategic real estate ownership. And with this, obviously, you need to do all the tax planning correct to be able to take the full set of deductions. And tax planning is something we do for a lot of our clients. Our calendar link is down in the show notes. So it's not just about buying the rentals, it's also about planning all this correctly so that everything holds up in the event of an audit. So what are some common mistakes I see? Number one, thinking your construction hours automatically count. They only count if they relate to real property trades or businesses that you materially participate in. And again, a lot of those are things I mentioned just earlier. Number two issue, not tracking your hours. So the IRS would automatically win when there's no log. Number three, trying to combine spouse hours. So you can't do that. So either you or your spouse would need to qualify individually as a real estate professional. Number four, qualifying but not grouping activities properly. So again, the election needs to be made for this, and that's something you want to double check with your CPA or your tax preparer on. And number five, assuming your CPA is proactive about this. A lot of times people would potentially qualify, but the tax planning hasn't been there. You only see or talk to your CPA once a year. So that kind of setup would cause you to not be able to use these breaks. So again, this is not DIY strategy, this is advanced tax planning. If you want to speak, if you have any questions for your situation, again, our calendar link is down in the show notes. So if you structure this thing correctly, it can really help you get ahead. So I hope you found this helpful and see you in the next one.